Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss the first green week after 7 consecutive weeks of decline.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us. Pennies.
Going in Raw.
Featuring Dan, Deity Dips, and Hugh Honey.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is May 29th, and after 7 consecutive weeks of decline, the longest losing streak since 2001, equity markets logged gains last week. Yeah, so, I mean, obviously this was a first green week we've seen in a while. It got down to around the 380s, so it did get spooky at times, but it rebounded properly. What do you think about all of it? Is this the start of, us potentially going up, or is this us just getting pump faked?
Yeah. So the one thing that I'll say is that first off, that is a sexy looking green candle. Okay. Very sexy looking green candle. It closed a full candle. I mean, wow. It's basically 387. I forgot that SPY had started inside the 380s this week. All the way to 415, and even after hours hitting tapping that 416 mark. So 2 things to this. One, if you guys have your charts open, check out the volume. Now, the volume the previous week was over 500 million. The volume this week was 400 million. Now, that's not a big difference. However, 2 weeks prior, the volume was 750 million. So, effectively, from that actually, it's not even that big of a week, but from 2 weeks ago to now, that's half the volume on a bigger move than double the volume made. So double the volume made a move from 429 down to 406. So, a similar move, but again, on half the volume into the upside. So that's the first part to this. And the second part is that I want to remind everyone, we're still significantly below the moving averages. The 10, the 20, the 50, the 200. I mean, we're below them all. And not below the 200. Sorry, I misspoke. But we're below the 10, the 20, the 50. And we haven't even, we're still a few bucks off of the 10. And I mean, we're 15 points off of the 50 and the 20. So we basically have to make the same move again to even test the 20 and the 50. And so around that 10 moving average, which is like 418.84, that's where I'd be looking to see if we reject some, because most of this points to, at least on the short term, extremely overbought. Again, on the extremely short term, like I'm talking like the day, like the 3 to 5 day mark, which again, that makes sense based on the move that we make. I mean, Friday alone, we had over a 2.5, basically a 2.5% move up. So that makes sense. I think that coming into the week, depending how it happens, if we gap down on Tuesday, I would suspect that we go higher. If we gap up, I suspect that might not be a terrible short, or a terrible short if we gap up.
In the short term, you think?
In the short term, yes.
Yeah.
Yes, strictly on the short term. I'm not going to speak necessarily like 10, 15 days out, but on the very short term.
If we wake up and it's 4, I mean, what's that now? 4:15. If it's at 4:30, I mean, I think you can expect it to end at like 4:20 that day,
Yeah, especially if we see like a nice little gap up to that 10 at that 4:19:30 or something, somewhere around then. I mean, I would be shocked on the current volume and like as we talked about is that with the current technicals and the current volume, I'd be shocked if we gapped up there if we didn't sell off. Again, maybe we don't, but that's something that I'd be looking for. However, that being said, if we gap down, let's call it like 411 or something. That's when I would probably be looking, to see if, especially if the technicals reset and we go from, if we go from overbought to neutral again, that gives some headwind to the upside. If those technicals come down. So that's what I'm looking for. But again, until we either break below that 380 or we break above and hold above the moving averages, we're still inside a range. So to me, it doesn't make sense to try. Like I saw a lot of people calling bottom. Personally, at 415, especially with no pullback, I'm not a buyer at 415. Same thing, like I wouldn't be shorting it like 380, but I do think that we see lower lows because, and this is what we talked about, or I tweeted about earlier in the week, trying to call bottom of a bear market, or at least the beginning of the bear market. I mean, we literally just entered the SPY crash zone, being down 20%. Is super tough. And it doesn't make sense. And the analogy that I use, I'm gonna recycle it just because I got a lot of love for it, was it's like trying to call your end during a basketball game, trying to call your end win percent or your field goal percentage halfway through the game. Like you might be right, but chances are you're gonna be wrong. And how'd you like that one? Big basketball guy.
Here's one for you. I don't even know if this really plays here, but so for LeBron's career, and this is true like last year, so it's probably still true. He's been playing so long. His career averages are 27, 7, and 7 over his 19-year career.
Okay.
Guess how many 27, 7, and 7 games he's actually had?
3.
0.
Wow. Yeah. Okay. Exactly. Yeah. You know what? Actually, I'm gonna take this clip and because there was a few people that were like, it really can't be that difficult, when you're halfway through a game and stuff. And I'm like, listen, if you were at 25 shots and you accurately can predict your shooting percentage by the 50th shot, I will come
just
and
play like fucking Ben Simmons and James Harden in the fourth quarter and don't shoot the ball at all, and your percentage will stay the same.
That's true. But yeah, so to my point, to that point, trying to call bottom, especially as we talked about like early in the year, is that the stock market can be bullish and the economy be bearish, and vice versa. Like last year the stock market was very bullish, and at least for the long term, what was happening inside the economy was not bullish at all. And now we're kind of seeing that, I guess, with 40-year inflation and consumer savings at 4%. But anyway, that's for a different day. However, this is to my point about listen, bear market rallies can be really, really, really tough, like max pain tough. And that's why, even though we're at overbought levels, I mean, we could still go higher, you know, like this is why, well, I'm not a huge fan of like the RSI and stuff like that. Like, I like it. I think they're contributing factors, but if the RSI is at 90, it can go to 110. Eventually, it'll come below 60 again. But in the short term, it can go to 110. So even if you have a month out calls or puts, like that can decay pretty hard on you, and especially with the price going against you. So that's the only thing, is that I wouldn't create a bias. If we get over the 10, the 20, and the 50, and we start to hold over that, yeah, then it's like, all right, let's see what we do against 450 and 460. But until that happens, just play what's in front of you. And then same to the downside, like if we break 400 again, my personal bias is that if we break below like 395 again, that we see new lows. However, I'm not like going to go all in and, have this personal bias against it. Because that's just stupid. So, same thing is that if you have a personal bias, just be realistic. It's the same thing. Like, it's similar to the episode last week with, when we were rebutting against Hunter. Like Hunter loves Bitcoin. He sees the future in it. However, he's not all in it, because and so that's like the smart way to do it. So that's all. That's on the market. We'll see what happens next week. Like I said, is that Wednesday, if we wake, or Tuesday, if we wake up to a gap up, I'd probably be looking short. If we gap down, and the technicals reset to neutral instead of overbought, then I'd probably be looking to buy it up.
All right. Well, this article says that the reasoning behind this week was, and you can rank these: selling exhaustion, positive retail earnings reports, and hints of Fed flexibility are all the things that helped the S&P 500 rebound from its lowest in more than a year. Which of those do you think was the most important between the hints of Fed flexibility, selling exhaustion, and positive retail ERs?
Okay. Side note before we rank them, because the article that Dan was talking about is talking about like consumer spending and stuff like that. The flip side of people spending money is that now our savings rate is at 4%. So that means that, I'll pull up the exact number. So the consumer savings index came out on I guess it was Thursday or Friday. No, it was Friday. And effectively, it fell to 2013 levels. The personal savings rate fell to 2013 levels, and the savings rate to 2008 levels, and credit card debt grew at a record-setting pace. That is fucking scary. So yes, does consumer spending usually signal a strong economy? 100%. But that's the same thing like with the market. We're not seeing much panic in the market, so it can't be a recession. Yes, 100%. However, the flip side to these things is that the S&P 500 is technically crashed. It's down 20, or was down 20%. It's technically inside a bear market. And then to the consumer spending point is that it's at 4.4%. That is so damn low. That means that if you're making $100,000, the average person is saving like $4,400. That's nothing. Like that is like, I can't even stress how crazy that is. If you guys can see the level that it was at, at certain times, I mean, it was significantly higher. And then you couple that with, debt, consumer debt reaching like record-setting numbers. That is fucking disastrous. We had said previously that I didn't really think that there was a massive crutch that would send us into a recession similar to 2008. And what I mean by that is that, with 2008, it was I mean, there's a lot of blame that we could put on, many different parties. But my point to this was that, there's different kinds of recessions. There's really tough recessions. And then, that last, like look at the Great Depression, that lasts like decades. And then you have like ones that you kind of, switch in and out of. And probably the average American wouldn't even really know that we're in a recession. And the problem that I'm seeing is that the Fed is going to have to tighten their balance sheet. And right now, we should be in what is the worst of it. Gas is $6 a gallon in some areas. We have serious supply chain issues. Inflation's at 40-year highs. Like, this is when it should be the toughest on Americans. And what we're actually seeing right now is that Americans are still spending and accumulating debt at record pace and not saving anything. So it's one thing when you have like accumulating record debt and you're saving a lot, but that's not what we're seeing at all. And so that's like kind of the scary part, because the other part to this, and shout out to a few listeners that I had conversations with this week about this exact topic, is that student loan pause has been in effect for 2 years. 2 years, over 2 years, I believe. I think it's like, I think at this point it's like 27 months or something. So that means that people who have student loans haven't really had to pay them. And I would say that probably a large majority haven't. And so when you couple the fact that eventually student loans will have to start being paid again, even if there is a $10,000.
That's probably. What do you think the percentage of that? I mean, the average American student loan is probably 40 or 50. I'm sure we can find it
easily. And it only it's only climbed inside the last decade. And that's the thing, is that let's just say your payment's $400 a month. What was it?
30,000. It's 39.3. So student loan.
39.3. So here's two points to this, and this was not even on the topic list for this episode, but fuck it. So here's the thing: is that if you you haven't had to pay for you haven't had to pay student loans. If you're paying $500 a month, which I don't even know the average payment, but let's even say it's $250 a month.
I think most people do $100 a month is like
$100 a month. Really, that's it?
But you gotta think that's just an extra bill for most people. Like they're already paying everything else.
Yeah, exactly. And so when you don't have to pay that for 2 months, and then all of a sudden that comes in out of nowhere, and you have to start paying that, even if it's Yes, exactly. When you haven't had to pay that for 2 years, and then all of a sudden that has to come into it, again, we're already at record-breaking debt and little savings. So that's where it's like, that's where you're only one or two catastrophic events away from, foreclosure on your home. Because the other part to this, and again, this wasn't even on the topic list, is that imagine if you picked a variable loan for your loans. Well, inside the past, 2 months, they've doubled effectively. Like the interest rate has doubled on those. So if you were, let's just say you were accruing, I don't even know, $3,000, let's just say $3,000 a year in interest. Well, now you're accruing like $6,000 or maybe even potentially more, because again, they've doubled. So if you picked a variable and not a fixed interest rate, you're really feeling that. And that's the type of thing where, again, like I didn't think that we were necessarily setting ourselves up for, kind of like a I don't want to say like a financial crash, but I'll say like, the crippling, the crippling debt, and the average American really getting the what's the word? Like the shaft, like I wasn't really, I didn't really think that the average American would get shafted outside of the 8.5 inflation, outside of the $6 gas, like I really didn't think that. But with all these things happening, you get enough people who, again, their student loan, comes back on and they have no savings And then, the variable interest rate is just the cherry on top. That's where you get into a situation where you can have 15% of America inside the same situation, in that situation. And that's where it gets fucking crippling and deadly. So effectively what I'm saying is that this was all to say that even though consumer spending, it signals a strong economy, it also can be a double-edged sword because of what we're seeing. And again, what I said was, a lot of different things would have to happen, but if those things do happen, and they are likely, or I'll say, they have a fighting chance, you can get yourself into some pretty deep shit. And so that was the roundabout way of saying that.
All right. Well, consumer spending, bad, sometimes good to others. So state of the consumer, it says consumer spending is buckling under the weight of inflation is the prevailing narrative, with the counterpoint being overall demand remains resilient despite economic headwinds. The earnings disappointments from some retailers were mostly tied to cost pressures rather than weakness in consumer spending. So I guess it's kind of almost what you said, just in a really complicated fucking way. So do you think the consumer spending is buckling under the weight of inflation? Because, I mean, at what point is it like the inflation too high? I mean, we go over it all the time, but at what point does the average American start to feel it to a point where they can't pay the mortgage, they can't pay the rent?
As far as inflation, I think it's less about the big expenditures, and I think it actually comes down to the smaller expenditures. Like, for instance, let's take the grocery store. I mean, that's the one that's, all over the news. If you budget, let's just say, and again, I'm just throwing out numbers because I've never had to shop for a family. But let's just say that you budget $500 a month for your family to grocery shop. And then all of a sudden, 8.5%. So inflation alone is going to chew 8.5%. But the part that we're forgetting is that we're also in supply chain issues right now. So that, milk, dairy, eggs, like the essentials are now going for sometimes 50-60% more. So not only are you feeling the weight of inflation on your actual dollar, you're also feeling that supply chain issue. I mean, I literally just went and I got like protein bars, eggs, milk, and something, and avocados, and a pound of chicken breast, and it was $57.
That's probably the avocado, dude. By the end of this shit, beef jerky is going to be like $73 at the gas station.
Well, that's the thing. Avocados. I looked. The avocados were $7. So like every item was effectively averaging like $9 per item. Like, that is fucking wild. So I think that like most of this comes down to actually like the smaller things. Again, like let's take gas prices. Gas prices were seeing what, like two like low twos last year. Now, I'm paying like it was like
180 in Alabama. Is awesome.
Yeah. Now you're seeing like like I saw like California is at like almost $7. So I think that that's another thing where you're gonna feel it. Where like you're gonna feel it more than like you might feel like that $100 extra student loan payment when it comes in. Because again, gas, you allot $200 for gas every month. Now it's $400. So now between just gas and groceries, you have to double your budget. So that's where I think where Americans are really starting to feel it. And that's where, the Fed had to become aggressive inside this tightening of inflation. The supply chain, they don't really have control over, and that'll work itself out. But the inflation part, I mean, think about it this way. If your net worth was $100,000 last year, without doing anything, you're already down $8,500. Like, without doing anything. Like, forget it if you lost money in the market, or you bought a car that depreciated a fuck ton already. Like, you did absolutely nothing, and you're down 8.5%. You're down the average return of the S&P 500 just for doing nothing. So I think that, like, again, is that I really thought that this would be the worst for the American population. But the more and more that these, consumer indexes come out, and the more that I see these numbers, it really gets startling. Because again, it's not really terrible right now. But again, you add in those student loan payments, the variable payment gets higher. And then all of a sudden, because again, when the economy's tough and, the Fed is tightening, that's when unemployment rises. So what about if all of this happens, and then not only do you not save anything, but you lose your job and you're laid off? You have no savings because we haven't been saving anything. Clearly, again, we're at like record lows. And then again, we're at record debt. So now, you have no income coming in, you have no savings, and your money is less valuable this year than it was last year. Those are the situations where, 15% of the population their world can be turned upside down.
Okay, so another one with the Fed policy being another one, with the prevailing narrative being the Fed will tighten until the U.S. economy enters a recession, with the counterpoint being the Fed may be more flexible than feared after 2 likely outsized rate hikes in June and July. So it's saying outsized rate hikes expected in June and July. What do you kind of expect for the Fed to... Because, the Fed is going to have a huge... because it's going to be in a point where you'd imagine when the next Fed meeting is, it's going to be at a real point of, hey, we're either going to be fucked or we're back on track,
So the one thing that typically, or that I saw that was really good, was the used car market index. On Friday, the Manheim used car index came out, and there was a significant drop. We went the last price was 54.2 this time last year, and now we just hit 9.7. So basically an 80% drop in the used car market. And that is the true. So remember we talked about how inflation, the way that works is that typically when it gets started, it's really hard to it's kind of like a truck rolling downhill. It's really hard to just put the brakes on. Same thing like once you curve inflation. Now this is the first metric that we've seen that is the first like true deflation that we've truly seen. And so if this is any signal towards what the inflation numbers are going to be next month, it would be fantastic. Listen, this was a pretty drastic drop. If we see inflation below like 7.5% or like, around 7%, that would really, that would really signal that what the Fed's doing is working, and maybe they don't have to be as aggressive. So that's what all this comes down to. And again, if the Fed eases, that's bullish for the fucking market. Okay? Because remember, the Fed is reactionary, but the Fed also controls the market. The Fed is literally the seesaw. So they tighten, market typically goes down. What do you call it? Yeah, they tighten, market usually goes down. They release their strength, and they ease off their chokehold. And that's bullish for the market. Now, the one thing though is that next month, I believe they start to ease on the balance sheet, and they start to dump some of the balance sheet off. And that's again one of those situations where even if they do ease from the rate hike side, from that side of it, if there's no demand and they're dumping all that supply, that's where it just comes down to simple supply and demand, and they will smoke the market. But I do think that a lot of it comes down. I think that that they'll probably just continue 25, 50 basis points, depending on inflation.
All right. Well, we got one more before we skedaddle, and it was inflation, which we've already gone over. So portfolio considerations, going into it, what do you think, should allocating your portfolio be right now for like cash and everything? Because it's definitely one of those times where you can fuck up or you can be getting in at the right and smart time.
If you're, is this for a long-term portfolio?
Yeah.
The long-term portfolio, index funds or what the hell are they called? Or the index funds or the target date funds. That's it. And if you want to scale into the index funds, because I actually had someone reach out, they got like $200,000 sitting on the sideline that they don't want to trade. They have another account that they're going to trade with, but they just have a $200,000 portfolio and they want to start scaling the market. I said, listen, I truly believe that we will retest that 390 mark. At that 390 mark, it's about 20% off highs. That is where I believe that you can scale in 20%. And the way that I do it is that every 20% lower, you scale in another 20%. And that's the way that I'm going to handle it. Next time that we retest that 390, 385 low, that's the way that I'm going to handle it with my long-term portfolio that I have sitting on the sideline. The amount that I have in cash, I'm going to take 20% of it, boom, invest it. If we go down another 20%, boom, another 20%. And that is the way that you can have a systematic approach to all of this. And you don't have to be like a crazy financier, like you don't have to nail the bottom, with this strategy. And that's the best way to do it. And then, And that's what I'm going to do. That's what I suggest. When people ask me, and it's one of those, like I said, systematic approach, stress-free, that you can deploy. And again, if you only get one scale in and market goes to all-time highs, great, you made some money for doing absolutely nothing.
And that's what we all like about trading. All right, guys. Well, we hope you guys enjoyed the episode, and we hope the market gets fixed and we all become rich again. So we'll see you all on Wednesday, and hope you all had a fantastic weekend. Take care.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.